The main macro feature of the coming week will be the Economic Policy Symposium that's held every year in Jackson Hole, Wyoming, USA, and is hosted by the Kansas City Federal Reserve. This get-together of the great and the good starts on Wednesday the 21st of August and concludes on Friday the 23rd. Now, some of you may think this is a week out for windbags. However, markets always pay attention to the speeches and seminars given by the central bankers and finance ministers who attend, and I'm sure that this year will be no exception. Remember, the US Federal Reserve has cut interest rates for the first time in a decade this year. The European Central Bank has hinted it could start cutting. The Bank of Japan has said it's poised to act. And the Bank of England? Well, the Bank of England has said it would like to raise interest rates but could cut in the event of a hard Brexit and that doing damage to the UK economy. I'd also suggest that the chances of the Bank of England actually raising when the Fed is cutting, well, they're pretty slim, at least if the last 25 years of history are any guide, although as we know, the past is no guarantee for the future. On the corporate front, a handful of FTSE 100, mid-cap and small-cap firms are due to update investors on current trading, their interim results or their full-year performance. Releases which could be informative include those from mining giant BHP Group on Tuesday the 20th of August, the same day when we'll get numbers from oil equipment and services specialist Wood Group. We've also got construction and engineering specialist Costain on the 21st. Another miner, Antofagasta, the Chilean copper giant, and also Premier Oil on the 22nd. And finally, Computer Centre on Friday the 23rd of August. But for me, the stock most likely to cause a big fuss in the week ahead is York headquartered house builder Persimmon. The FTSE 100 firm is due to release its first half results on Tuesday the 20th of August. As we can see here, the shares are down quite a bit over the past year, and Persimmon shares have been really buffeted by concerns, justified or not, over how the UK economy will fare post-Brexit, whether the housing market's overcooked and due a correction as affordability remains a key issue, and also a few self-inflicted problems for good measure. Now these include shareholder concerns over governance and executive pay, which ultimately saw Chairman Nicholas Wrigley and then Chief Executive Officer Jeff Fairburn leave the firm, and also growing customer complaints over build quality. That issue of build quality and customer satisfaction will be important at the first half stage, as Persimmon has taken a decision to slow down sales to improve the customer experience and make sure that they're happy. This could be seen in the first half trading update of early July, when Persimmon revealed the following key metrics. A 7% drop in legal completions to just under 7,600 units, almost flat average selling prices at around £217,000. That continues the trend of ever smaller increases seen over the last couple of years, and again harks back to the issue of housing affordability. And those two add up to a 5% drop in sales to £1.75 billion. Persimmon also flagged that the group operating margin for the first half would come in at pretty much the same as the 30.8% figure achieved for the whole of last year, excluding one-off items. That implies an operating profit of around £540 million against £518 million in the first half last year, again before exceptional items. Also keep an eye on the land bank, which came into just over 99,000 plots with a book value of £2 billion at the end of last year, and also the net cash pile. That cash pile exceeded the £1 billion mark at the end of 2018. This is important. It's this liquidity which helps to fund the purchase of new plots of land and drives future growth, but also funds dividend payments to shareholders. Remember, Persimmon has a plan to return £13 a share in cash to investors between 2013 and 2021. It's already handed over £7.20 in dividend per share payments, and further payments of 2.35 a share, 2.35 a share and 1.10 a share are due in 2019, 20 and 21 respectively. If the payout for this year is confirmed at 2.35 a share, that equates to a dividend yield of around 12% as I sit here, pretty much the joint highest in the FTSE 100 alongside fellow builder Taylor Wimpey. But anyone seeking that income must note that the cash per share distribution is currently scheduled to more than halve to 110 pence a share in 2 years' time. The economic cycle, Brexit, the lifespan of Help to Buy scheme could all influence Persimmon's future cash return decisions alongside the firm's own specific operational performance and customer satisfaction levels. So you will need to do your research before you can decide whether the potential capital and income returns on offer from Persimmon's shares compensate you for the possible risks involved and also fit with your own personal overall investment strategy, target returns, time horizon and appetite for risk. Thank you for watching, and I look forward to seeing you next time.